Welcome to another explainer. Look, if you've ever felt like cost accounting is just, a bunch of dry, historical numbers trapped in a dusty ledger somewhere, get ready to completely flip that perspective. Today, we're transforming those traditional concepts into a dynamic, highly effective toolkit for modern business operations. We're going to see how the smartest companies have totally re-engineered how they make, track, and price their products.
To get our gears turning right off the bat, I want to hit you with a quick knowledge check straight from our source material. What does demand pull actually mean in a modern business context? Is it about just forcing goods onto shelves, or is it something else entirely? Keep this question in the back of your mind as we explore the whole pull metaphor throughout today's explainer.
Here is our roadmap for today. 1. The lean manufacturing revolution. 2. Perfecting the flow. 3. Costing from cradle to grave. 4. Market-driven target costing. And 5. Simplifying with backflush accounting.
Okay, let's dive into Section 1, the lean manufacturing revolution.
So successful businesses are actively ditching old, sluggish manufacturing habits and embracing the lean revolution. Modern accountants have heavily criticized traditional production methods, and honestly, for good reason. Traditional production is pretty much obsolete. It accommodates and sometimes even rewards inefficiencies. There's just no incentive to improve. But in stark contrast, we now have AMT, or Advanced Manufacturing Technique. This is the new umbrella term replacing all those obsolete methods. AMT promises high-quality goods at low costs, ultimately maximizing customer satisfaction. It is literally how you stay competitive in a technologically driven world.
Now, the real star player under this AMT umbrella is the Just-in-Time, or JIT system. Originally developed in Japan, JIT has been widely acclaimed as a huge contributor to their massive manufacturing success. Its core mission is simple but incredibly powerful: producing or procuring items exactly when they're required without compromising quality. The goals of JIT are almost hard to believe. We're talking no opening or closing inventory, zero production wastages, and batch sizes of exactly 1. It completely eliminates non-value-adding activities.
JIT essentially has two sides to its coin. On the purchasing side, it involves highly reliable suppliers making frequent deliveries only as required. This saves massive amounts of factory space and capital that would normally be just sitting there tied up in inventory. On the production side, it works on similar principles right on the factory floor. Production is only triggered by a confirmed order from a customer. This perfectly illustrates how that demand pull mechanism operates. The customer's demand literally pulls the product through the manufacturing line, which drastically shortens setup times.
But a quick word of warning here. This highly efficient demand pull system, it lacks flexibility, making it very vulnerable to supply chain disruptions. For a JIT system to survive and thrive, you absolutely must have two non-negotiable assurances from your suppliers. First, prompt delivery at the exact time you need it. And second, 100% quality with zero rejects. If a single part arrives late or defective, the whole chain stops cold. So, how do we manage this incredibly delicate process when supply times are lengthy or demand is just hard to forecast?
Which brings us to Section 2, Perfecting the Flow. When demand is unpredictable, you have to be able to respond quickly, and this is achieved using the Kanban system, which really takes JIT a step further. It acts as a demand signal that spreads all the way through the supply chain. Instead of just fine-tuning schedules, Kanban is a perpetual inventory signal. The warehouse delivers components to the production line exactly when they're needed, meaning absolutely no storage in the production area. It keeps the supply processes as lean as humanly possible.
Now, tracking all these moving parts could be a total clerical nightmare, right? So here is another quick question for you. Which specific Kanban feature eliminates common manual entry errors? How do modern companies avoid making disastrous manual mistakes in such a fast-paced supply chain?
The answer is eKanban, and this brilliantly illustrates how electronic integration completely optimizes warehouse management. By digitizing Kanban, companies eliminate manual entry errors entirely. It provides quick and precise info, completely avoids overproduction, and allows for real-time demand signaling across the entire supply chain. Suppliers get an instantaneous picture of inventory levels, turning the whole operation into a seamless, perpetual flow.
Moving right along, let's hit Section 3, Costing from Cradle to Grave.
Stepping away from the physical factory floor and into the strategic boardroom, how do we actually track the costs of these lean products over their entire lifespan?
Well, this brings us to life cycle costing, sometimes called cradle-to-grave or even womb-to-womb pricing. This method captures absolutely every cost incurred on a product. The purpose here is simple but crucial, ensuring the firm recovers all its expenses over the estimated number of units it expects to sell. This big-picture view is vital because it helps a firm compete favorably with pricing, especially when competitors start introducing similar products.
To really grasp what cradle-to-grave means, just follow a product's journey. It starts at the cradle with research and development costs. Then it moves into the costs for plant and equipment. Next comes the actual manufacturing costs we just talked about. And finally, it tracks costs all the way through product development to product promotion at the grave. Life cycle costing leaves no stone unturned.
Next up is Section 4, Market-Driven Target Costing.
Sometimes the market dictates the price before a product even exists. This approach is called target costing. Widely used in Japan and rapidly gaining ground globally, this is a highly market-driven approach. Instead of making a product and then trying to figure out what to charge for it, new products are designed from day one based on the unit prices potential customers can actually afford or are willing to offer. Because the design stage consumes a huge chunk of a product's overall costs, this is a proactive accounting method rather than a reactive one. Product designers, purchasing teams, and manufacturing specialists all have to work together right up front.
So the crucial point here is how simple and frankly active this math really is. Let's step through it. Step 1. You determine your competitive market price based on gaining your desired market share. Step 2. You subtract your required profit margin from that selling price. Step 3. That number leaves you with your target cost. If your target cost is $10, you have to engineer the product to cost exactly $10. It's a total paradigm shift in cost management.
And that brings us to our final stop, Section 5, Simplifying with Backflush Accounting.
So we've reached the final destination of our lean journey, the accountant's desk. With all these lightning-fast JIT processes and zero inventory systems, how on earth do we record all this without bogging down the financial books in administrative red tape? The answer is backflush accounting. Contrast this with traditional costing, which requires exhaustive, detailed tracking of material movement through stores and work in progress, or WIP. Backflush costing throws that entirely out the window. Associated directly with a JIT system, backflush accounting starts at the finished goods and works backward. It attaches costs directly to the output produced, meaning there is no separate, tedious accounting for WIP or stores. It dramatically reduces clerical cost and effort.
Just notice how beautifully simple these journal entries become. When raw materials are purchased, you just debit raw in progress and credit bank. For conversion costs, you debit conversion cost control and credit wages payable. And for the cost of goods sold, you simply debit cost of sales and credit finished goods. That's it. Instead of mirroring every tiny physical movement on the floor, the accounting relies on the assumption that backflush costs are a realistic measure of actual costs incurred. It's elegant, and it's perfectly tied to a lean system.
To bring it all together, let's lock in your newfound mastery with one final quiz question. Which system that we just discussed starts from finished goods and works backwards, specifically to reduce detailed accounting entries?
If you said backflush accounting, you absolutely nailed it. By implementing systems like JIT, Kanban, target costing, and backflush accounting, a company doesn't just cut corners. It streamlines operations from the factory floor all the way up to the financial books. It's really about removing the bloat and focusing entirely on value. So as you look at your own workflows or business models, I want to leave you with this final thought. Where are you accommodating inefficiencies right now? And how could a demand-pull mindset completely revolutionize your output today? Thanks for exploring this with me, and keep leaning into better business practices.